Hello and welcome back to my channel. Socially responsible investing, impact investing, and ESG have become talking points, not just in the private capital space, but in the public capital space as well. ESG has clearly gone mainstream, and the global pool of exchange-traded funds is estimated to exceed by now $100 billion. Companies are raising ESG or their compliance in ESG in their AGMs, and obviously private equity asset managers have actively been creating products that fit the demand from their investors. In 2020 alone, private equity firms raised in excess of $380 billion of committed capital. That is significantly more than in the prior years. Nevertheless, there are some concerns as well. A recent survey by Institutional Investor found fewer than 10% of about 8,800 private equity firms with a total of 3.5 trillion in assets under management are signatories to UNPRI. So clearly there is headroom. In 2020, INSEAD's Private Equity Center decided to take another look and listen to both players, both the investors in private equity funds as well as the fund managers, and see whether their expectations and the outcomes match. So let me share with you a few of the salient points out of the study. The full study will be shared in the video right below. So please feel free to download it and also share it liberally. The study is called Green Shoots, the Changing Role of ESG, Environmental, Social, and Governance in Private Equity. So let me start by describing first what I consider the spectrum of responsible investing. So private equity on the one side would be the hardcore funds that are focused on financial returns. And on the other side of the spectrum, we have vehicles focused mainly on social returns. And as you will appreciate, as it's a spectrum, anywhere in between here, funds can choose where they are looking to play. So that basically reaches from negative screening, do no harm, to proactive ESG management, impact investing, and all the way to what we call venture philanthropy. Now, the conversation around impact investing and ESG started in 2005 with a report for the UN created by Freshfields. Since then, both LPs as well as GPs have started to discuss and reconsider their priorities. So from focusing on risk management, doing no harm, to ESG, true ESG stewardship, both in the private as well as the public equity markets, led by some of the large institutional investors. So ESG considerations in private equity are nowadays clearly more prominent, and this chart shows this quite clearly. So from 2010, just in the last decade, we have seen a significant increase of private equity funds that are focused or have a mandate that involves ESG. And clearly from about 2016, 2017 onwards, some of the large players have started to step in and raise significant funds, raising the question, is ESG going mainstream? So in 2020, private equity firms raised in excess of $370 billion of commitments. So recent surveys, as I mentioned before, have nevertheless put some question marks around that. Now, the growing significance of ESG in private equity has grown, I would argue, in line with the increase in assets under management. So private equity portfolio companies have become clear contributors to, for example, just using one measure, to CO2 emissions globally. So within 15 years, the estimated total share of global carbon emissions attributable to PE investee companies has grown from 2% to 7%. So, and we're clearly on the way towards 10%, raising the question, what is private equity doing about this, and are they trying to act against it? So nevertheless, in practice, there's a gap between aspirations, what portfolio companies and investors would like to do, and the reality. So the top challenges that are usually raised when we talk to the players with regards to ESG and impact investing is, number one, it's too costly or time intensive. We don't have the manpower to do it. There's inconsistency. Those reports we're receiving are not comparable. And the benefits with regards to value added are not clear. So can we connect those ESG efforts with clear, tangible, measurable benefits? So, and as you can see, quite a large number of respondents agree with the statement that sustainability reports should be audited in a regular interval. So clearly there's work to be done. So we analyzed at INSEAD data from over 100 LPs, the limited partners, investors in private equity, and GPs to outline or try to find at the time best practice and design action steps for those funds that are sitting on the sidelines contemplating whether to jump into the ESG dedicated fundraise. So let me share with you first the key findings that we had from the limited partner survey. Now, first question we asked, share with us the frameworks that are most important to you. Share with us the top 3 frameworks. Clearly, we have 3 winners: UNPRI, the Sustainable Development Goals or SDGs, and the accounting framework. Those were clearly the ones whereby UNPRI and the SDGs are by far ahead of the other ones, just simply in terms of how many institutional investors are using those as a benchmark. Environmental sustainability and employee well-being are the 2 most important themes for LPs. And what we did, we looked at various SDGs that basically relate to it. Number 4, education. Number 3, health, affordable and clean energy, and so on. So, but very clear, those are the 2 outcomes that stand out. LPs also believe that ESG will become more important than right now in 2020 in the next 5 years. So this kind of gives an incentive for GPs, for the private equity funds, to really try to be thoughtful and considerate around how they execute and implement ESG in their portfolio companies. So the 33% of the LPs said they receive information on ESG-related risks and opportunities, but only 11% believe that they are provided data that is granular enough to help them really understand what's going on on the fund side. Many LPs also say that GPs tend to focus on ESG mainly around fundraising. So as then fundraising is complete and the investment cycle starts, the reporting and the effort around ESG tends to decline. Again, that's the impression that the LPs are receiving. So obviously one would imagine, one would wish that, especially on exit, the GPs would take the opportunity to really relate their ESG efforts to the most important deliverables, to the most value creating outcomes. Now, this is our study, so please, as I said, it's right below this video, please download it. We wanted to find out how this now basically connects. So obviously what we had to do, we had to listen to the other side of the aisle, and we reached out to the GPs. But also what we did, we simply conducted an analysis of publicly disclosed information from 50 GPs. So all we wanted to do is find out what are they doing in ESG, how important is ESG to them. And then we basically interviewed a few of the GPs that are close to INSEAD. So what we found is very clear. ESG disclosure for GPs by GPs varies dramatically. So we felt for the LPs, it's hard to basically compare apples to apples when one receives very, very different levels of information and clearly very different reports with very different levels of detail. So 3 key principles for top performing GPs in ESG were: number 1, transparency and rigor. So they clearly outlined their ESG approach, had a very clear framework, and measured consistently across all their portfolio companies. Comprehensive measurements, something that is harmonized, is a harmonized set of measures, not basically that doesn't change from fund to fund or from portfolio company to portfolio company. And they have clear targets and measure whether those targets have been reached. Proactive funds track similar metrics across the portfolio companies. Again, that makes it basically easy to compare. So those top performing funds, they do track carbon emission, waste treatment, water use, employment, gender diversity, and so on in their portfolio companies. So this could be some guidance for those GPs that are just starting on their ESG journey. Now, a few recommendations that we dared to make, and obviously we would like to hear from you with regards to measures that potentially made sense or worked for you in your portfolio company. So number 1, talent is crucial. Talent inside the GP to ensure full alignment between those aspirations and the actual implementation. So clearly the ESG experts need to have a seat at the table. They need to be part of the investment team and the portfolio teams as well, those that work with portfolio companies once investments are made. So again, clear accountability is paramount. And obviously back to our cycle, not just focusing on ESG during fundraising, but across the life cycle, and especially when it comes to exits, clearly pointing to what actually drove the returns in those portfolio companies. Was ESG a vital input is paramount. So thank you very much. And as I said, we will share the full report below this video. We also, as INSEAD, invite players in the industry to come back to us. We're happy to share scorecards with regards to GPs, and we invite the industry to work together to arrive at a framework that allows both LPs and GPs to measure the hard work that they're doing to ensure that environmental, social, and governance remain a talking point inside their portfolio companies and are not just a phenomenon for the short term, but for the long term. Thank you very much. If you like the video, please hit like. And if you'd like to see future conversations around impact investing or around private equity and venture capital, please subscribe to my channel. Thank you very much.